Good afternoon, everyone, and welcome to our webinar designed to help South Africans looking at relocating home. I'm Mark McAllister, Senior Partner for Holborn Assets based here in Cape Town, and I've been helping returning South Africans get financially fit to return for the last 6 years. Please feel free to connect with me on any of the social media channels listed on screen now so that you can receive the very latest updates on what you should know when getting financially fit to return. Okay, so here is what we're going to cover today. So we're going to go through the specific needs that you as a South African have when you come back and what you're probably thinking about in relation to the financial planning needs. We're going to go through some basics. We're going to talk about things like foreign exchange, so bringing cash back to South Africa, how you do it, also how you shouldn't do it. We look at things like retaining UK bank accounts and credit footprints. I appreciate, we've got all nationalities on here today, but actually the vast majority from the UK, so it'll be a little bit UK centric in that regard. And it's the same when we come to talking about investment properties. Do you retain that house in Southwest 19 and rent it out when you come back to South Africa? All of those ideas and more will be covered today, including the dual tax agreement and wrapping up with things like pensions, retirement planning, estate planning, all those kind of points at the very end. One of the things we will be including, is a new topic we've only done once before, is a returning South African family budget. We've done the hard work for you, so if you're scratching your head on how much it costs to live in South Africa these days, we've got a good template that at least give you an idea of all the things you should be thinking about when making your plans around financial budgets when you come to South Africa. Okay, there is a section at the end for answering questions, and I'd request that you utilize the Q&A button. If you haven't used Zoom before, you'll find it at the bottom of the center of the screen. Feel free to ask any questions as we go along when you think them, and I will answer them all together at the end. But thank you all for taking part. I really do appreciate you taking the time to join us today. Okay, so let's get started. By ways of introduction, let me give you a little bit about us. So Holborn Assets is one of the largest and longest established privately owned financial advisory businesses globally. We've been around since 1998, and now these days we look after about $3 billion under management and administration. We've got clients in 30 different countries. We've got offices in 11 different countries, and we're licensed in places like South Africa, the UK, but also America, Europe, Hong Kong, and many other places besides. So in South Africa, we have offices in Johannesburg, Durban, Winelands now, and also Cape Town, which is where I am the senior partner for the group. Feel free to have a look at us on Trustpilot, and what you'll see there is that we've got over 1,800 very happy client reviews from the services we've been providing globally, of which obviously a large proportion are our clients here in South Africa. Okay, over recent years, South Africans have dispersed far and wide around the globe. Here is just a small selection of the countries some of our clients have returned to South Africa from. We would highly recommend that you work with an advisor who knows about the jurisdiction that you previously lived in and worked in, and knows things about things like local tax rates, any dual tax agreements, and what works best on your return to South Africa. So, as both a locally qualified representative with the Financial Services Conduct Authority here in South Africa, I'm also a level 4 qualified UK and internationally certified wealth manager with the Chartered Institute of Securities and Investments in London. They really are the benchmark for educational and qualification standards in my industry. So we're very happy to assist with any questions or queries you might have in this regard about how we can assist. And though I specialise obviously with my background, the accent kind of gives it away. Looking after clients from the UK, we've got experience of looking after clients from all over the world. Okay, so let's get started. And enough about us. Let's talk about the basics of financial planning. So first things first, you've decided that you're going to make that big bold move back to South Africa. Maybe it's a result of COVID and various other issues that were happening up in the northern hemisphere. Whoever would have thought that we would see a potential European conflict and a pandemic within the same sort of 2 to 3 year period? So the world is a challenging place, and maybe home is calling to you. Maybe you miss friends and family. Maybe you just miss the weather or the freedom that you would have back here. But regardless of that, I'm assuming that if you're watching this, you've made that choice to move back. First things first, you're not alone. There's a lot of people that have done, but let's look at the basics of what you should be thinking about, what a good financial planner will do if they're cross-border experienced like I am. So all financial planners will carry out a version of these 6 steps that you see in front of you to create a financial plan. You can obviously attempt this yourself, but no different to other professionals, like a doctor or a lawyer. A good financial planner will have seen and heard similar stories to yours from numerous other clients over the years, and we can give you the benefit of their collective experience with whatever it is that you're thinking of doing. So, starting firstly, we need to assess your financial situation. And if you don't already have one, you need to create a budget. That's the first sort of big step. And work out what you think your income and expenditure needs are going to be when you come back to South Africa. From this, you can then start to set some goals depending on your age, your lifestyle, and at the end of the webinar, like I said, I've got this free tool, budgeting tool, to help you with that. Now, one of the key first steps, though, is to understand what you have. We call those in the industry your assets, okay? And then on the other side, we have what you owe. These are what are called liabilities. So examples of assets are things like cash that's in your bank account, your property, perhaps you have a workplace pension, all those kind of things. You might even have some cryptocurrency stashed on a Trezor wallet, Krugerrands in a briefcase. I've heard so many different examples of things that could be construed as assets on that side of the fence. Liabilities and examples of those are things like credit card debt, loans, overdrafts, mortgages, and maybe you have an outstanding tax bill. So first things first, you need to look at taking your liabilities from your assets to give you a figure that what we call in the industry is your net asset position. This is in theory what you're worth. It's what the taxman will be interested in at some point in your life. And once you figure that out, that gives you something to consider when you start to budget for your move to South Africa. And as I said, we'll wrap up today's webinar with a sample budget. So now that you know what you're working with, your net assets, let's think about how much you would want to take back to South Africa. And perhaps what I should say, though, is how much should you take back to South Africa? So let's think about it this way. Let's say we're 20 years in the future, looking back to today. Okay, and let's imagine we've got this 0 to 100% scale in front of us. 100% is that South Africa is, there's full employment. It's a leading superpower. There's no corruption. I would say certain politicians, are in prison. Maybe that's a bit contentious, but it's the rainbow nation that I think Nelson Mandela envisaged. So if you want to have an example, look at Singapore. So let's call this the Singapore scenario. Maybe 4 rands to the pound, something like that. At the other end of the scale is like the 0% scenario, the naysayer scenario. It's gone the way of Zimbabwe or Venezuela. So the currency is on the floor. Corruption is more widespread than ever. There's no food. There's no fuel. All those kind of terrible situations to think about. Let's be honest. I don't think either of those scenarios is going to happen. Let's look at that scale and make a decision of where you think it will be in the future. And that's something we use as financial planners in our planning, sort of like a helicopter view. So let's look at your investment portfolio. If everything you own from property, savings, investments, etc., and you believe that the future for South Africa is like Singapore, then great. Match your investments to your gut feel and your belief for the future. If not, though, if you've maybe got a little bit of a nagging doubt, maybe that voice in your head or the voice on your shoulder, as it were, saying maybe not 100% sure, how much should you potentially keep out of the country, offshore? maybe in places like the UK, America, Australia, or other jurisdictions that are, quote marks, safer and more secure. So this could be anything like 25% offshore, maybe half, 75%, or the majority offshore. But regardless of what you do, it's your decision, and it must match what you believe and you're comfortable with to have invested in this country a long time into the future. It might be tempting to put the cash in the bank for what may, on the face of it, seem like a high interest rate down in South Africa, particularly when we've got 0.25, 0.5% rates in the developed world for interest in a bank. But it's extremely hard to see the hidden killers of your wealth, like taxation, inflation, and currency depreciation. And I'll cover some of those with examples as we go today. Bottom line though, as I said, it's your decision, nobody else's. But diversification is something you have to think about. Okay, it's key to an investment strategy. Don't have all of your eggs in one basket. Let's look at what's going on in Russia as an example recently. Their stock market has been closed. Their currency halved in a few days. Exchange control stopped you from getting rubles out of the country. Yes, it's an extreme example, but it can and it does happen. So we need to think about that. And in the event of a worst case scenario, you may need to access a ring-fenced offshore investment solution. So many local options here in South Africa will involve your assets going out of the country, perhaps in what we call asset swaps. I don't want to bore you with the jargon today. And these can be subject to things like those exchange control limits. Currently, that's 1 million rands per individual without certification. That's your sort of a personal allowance. And you can take another 10 million rand each with clearance from SARS and the Reserve Bank. Now that's a key point, because again, I come back to the Russia example. What if you see South Africa aligning itself to something like Russia, and potentially it becomes subject to sanctions in the future? Could South Africa potentially see a further reduction in exchange control, or even worse, could exchange control be shut almost overnight? The answer is it can. It doesn't need an act of parliament. It's set by a policy committee at the Reserve Bank. So just something to be aware of when it comes to risk. What about currency? I mean, this is one of the key questions I'm often asked. First things first, Mark, what's the exchange rate going to be in the future? Well, sadly, I'd love to be able to tell you what the exchange rate is going to be. I don't think anyone can truly give you an accurate picture. We affectionately call it in the industry a tango currency. It's one step forward, two steps back. But let's have a look at it over the last 40 odd years. And what you can see when you compare it to the pound as an example, is that it's significantly depreciated over 40 odd years or so. The underlying trend is only going in one direction. It's down by almost 1,200% over that time frame. So in 1980, 1 million rands would have got you £540,000. Today, it's going to get you about £52,500. Okay, it's hard to understand why though. So let me give you a real world example. I've got a client in Bishop's Court. He bought a lovely house, a mansion there in the 1980s. Bought it for about 100,000 rands. Okay, it's now worth today 23 million rands. So on the face of it, sounds great. He's done a great job from an investment perspective. Not really that you should see your main residence in an investment, but there we go. There's the benchmark. Now, he had the opportunity to invest in a property in London in the 1980s when the currency was about 1 to 1. So he could have put 100,000 rands into pounds, and he could have then gone and bought this property. That property on Zoopla, and the guys in the UK, I'm sure will know that website well, is now worth 14 million pounds. Okay, that's 290 odd million rands at current exchange rates. So let's take this chart out of the equation. Let's take depreciation, inflation, and all that sort of stuff. Let's forget it. And let's just use this example as the unit of exchange. By buying in South Africa 40 years ago, even though it's gone up in significant value, he's lost the purchasing power to the equivalent of about 12 mansions. Okay? It's a really key point when you're thinking about bringing money back into the country for the long term. Okay. As a lot of you on this call obviously are heading back from the UK or Europe, let's look at the benefits of retaining a bank account in somewhere like the UK. Well, firstly, why would you want to? Well, it's an ideal option to keep some foreign currency, and perhaps you might have a direct debit going for a UK phone. I know a number of clients that do this. Why would you want to do that? Well, because it allows you then to accept one-time PIN codes if you've got banking arrangements overseas. So one of the things I encourage all of my clients to do, go and have a look at one of the free digital banking apps. There's some great ones. I'm a big fan of Revolut. Wise is another one, Monzo, and you can send money backwards and forwards effortlessly. Okay, the exchange rates and the fees that banks charge you to do this are enormous. Okay, never send money down to South Africa using a high street bank. I mean, it will cost you a fortune. Okay, what you can do with these kind of latest generation fintechs is you can swap pounds for rands at probably the best exchange rate you'll find, and then you can send those rands straight from that wallet down to a South African bank account. You'll still pay a very small fee on the inbound side of things, but it won't be anywhere like the amount that you would have paid if you'd sent pounds down to be converted into rands along the way in the traditional banking system. You can also link it up to the likes of SnapScan, other apps. So if you do nothing today, download one of these, give it a try. I really don't think you'll regret it. Obviously, if you're thinking about retaining investment property in the UK or somewhere else, you're going to need a bank account to handle rental payments. So again, this is one of the reasons why you might be thinking about doing this. Okay, it's a big point to talk about. Did you acquire property in an overseas market when you're an expat? You're thinking about leaving it there and renting it out. You're aware of all the tax and legal implications of doing so. Well, since 2015, again, we use the UK as an example. Capital gains tax has now changed, and the foreign landlord rates between 18 and 28%, combined with things like estate agents' fees, you could lose up to 30% of your investment if you needed to sell at some point in the future. You can also no longer claim the interest portion as a legitimate expense, and so the tax bill might be higher than you think. And then there's obviously the ogre of, who should you be paying that to? Should you be reporting to the HMRC? Should you be reporting to SARS? And at what point do you make that change? And again, that's something we can give you a bit of guidance on a one-to-one basis. The last thing that I always recommend clients do before they make the move back, if you're thinking about keeping it, try and get your mortgage sorted out before you go. Okay, once you're back in South Africa, everything becomes more expensive, sadly. Trying to use the NHS, you're so used to it when it's free, you come back to South Africa and have to pay for it. There's so many expats that just find this mind-boggling. It's a much smaller market down here, and it's a higher risk market. So if you want to remortgage your investment property, 3, 4, 5 years in the future, you're going to pay a higher rate of interest. Okay, you're probably not going to get as good a loan to value. We have access to providers that do the best for expats, but my advice is always, if you can get that buttoned up before you go, or you want some advice on how to get it buttoned up before you go and speak to a mortgage broker, or have a chat with us if you're not sure who to speak to, and get that sorted out before you go. Certainly the high street banks, these guys that you can see here, they're really not that friendly to the likes of expats once they move back overseas. Okay. One of the best ways though to grow your wealth is through leveraged property. Most people don't like talking to financial advisors because, particularly in South Africa, they think all they're going to do is sell them a retirement annuity and a life insurance policy. I've been a landlord in the UK for 20 odd years. I've been a commercial landlord before, so I extol the virtues of investment property, particularly in the UK, to clients all the time. It's a great asset class. I've done webinars just on investment property. And there are questions about, can you make it more tax efficient? Yes, you can. There are options to own investment property in things like cost-effective limited companies, or even a pension fund. Why not, come along to one of our more detailed seminars in the future, or drop us a message, and I can give you a little bit more of an idea of how we've helped dozens of expat landlords structure themselves effectively to be back in South Africa. Okay, one of the areas I'm often asked about is the dual tax agreement between South Africa and the UK, particularly if you're thinking about becoming a digital nomad on your return to South Africa. And the short answer is you should. I've got so many clients that are doing this now. It's great to see people working remotely in London, but they're living in Cape Town and enjoying the life down here. So again, you're not on your own if you're sat here considering those options. But a dual tax agreement does exist. It was put in place to make sure that you're not taxed twice when you live in one country but have assets or employment in another. So there are a number of ways you can fall foul of the DTA. Okay, and I've heard so many examples where people misinterpret it. It's easy to do so. So it means you shouldn't pay tax twice, but it doesn't mean you can avoid tax completely. You still have to pay something to Caesar, and ultimately what we want to make sure is you only pay what is due to Caesar. That's not overpaid unnecessarily. So if you think that you might be able to sort of skirt under the radar, I'm sorry to tell you this, but it's not going to work. There's a data sharing arrangement called Common Reporting Standards. Just Google it now if you want to learn what that is. It's a big data sharing agreement. Both South Africa and the UK signed up to it in 2016. So they will know about what you're doing. So don't assume that you can return to South Africa and earn away in the UK and never pay tax on it. It's a really unwise strategy. But in short, I'm a big supporter of digital nomads. We've got a lot of clients looking to do it. We will facilitate everything we can to support you in that journey. If you want to learn more, like I say, just reach out to us. And one of the things that, again, is a positive about South Africa is it's one of the most tax efficient jurisdictions for pensioners, the subject that I'm going to come on to now. So I really don't like the term retirement planning. I think it's really outdated. And instead, what I like to talk about is financial freedom. Okay, so think about this as a date where you're working not because you have to, but because you want to. Maybe you're going and starting up a little business, a coffee shop or tourism business or something like that. It's a guest house perhaps. But you don't have to do that if you don't want to. You're doing it to keep some purpose in life, which I highly recommend. Maybe it's some charity work, something like that. However, how much time have you really spent about what financial freedom could look like when you return to South Africa? So what do you want to be doing? What is your ideal retirement? What does it look like? And do you have a sufficient income that's going to be able to meet that so you can do what you love and enjoy? So here's a bit of a question for you. Do you think you've got sufficient provisions in place for your retirement? Do you know where to start to work out if you have or not? And that's something that we can assist with. But one of the things I'd encourage you to do, though, is really think about how much time should be allocated to this rather important question. Are you going on holiday this year? Maybe you are. Maybe it's now that COVID's lifted, there's a 2-week holiday plan somewhere. How much time have you spent planning that 2-week holiday? No doubt it's a few hours at least, particularly when we've all been stuck inside for so long. One of the things you've got to look at is that potentially retirement is almost a 30-year holiday, and it should be worth at least a few hours of time each year to make sure you're on track for the retirement that you deserve. If you don't think you are, don't bury your head in the sand. Have a chat with us, and we'll be able to help you understand where you are. The bottom line is, there's a great old analogy. It's an Indian proverb. The best time to start saving was 20 years ago. The next best time is today, so don't delay. The longer that you leave it, the harder it gets to hit that goal, is basically what I'm trying to say. So if you start early, you're in your 20s, the number of steps that you've got are a lot smaller and more manageable. The more time that's left, the longer it will take you until eventually, it's too steep a mountain to climb. It's almost like going vertical. So if in doubt, start today. It will make a big difference the sooner you begin. Okay, with retirement plan, though, done correctly, passive income options can be built up to provide a full-time salary, if you want, when you move into the age that you want to retire. Now, this is a very important part of our role. We do that by selecting investments that protect and grow things like your pensions and savings, to provide for this sort of 30-year job, if you want to call it. We're all living longer. It's probably going to be longer than that by that point. But as part of the planning process, a financial advisor will identify a number of things. One of them is your attitude and capacity for risk. This also takes into account things like your age profile, how long you've got until you retire or want to be financially free. Nobody is the same though. So we don't do off the peg solutions. Everything that we do is bespoke, and that takes into account your age profile, your needs, your risk profile, and the long-term goals. We aim though to make your money outlive you, not you outlive your money, if that's what you're trying to achieve. Okay, one of my core area of specialisms though is helping returning South Africans reconnect with their UK pensions. So you can find that those will greatly improve your retirement in South Africa. It's likely you will have paid into a pension fund, a private one at some point whilst working abroad, particularly in the UK because they have an auto-enrolment system there. Did you know that there's nearly £19 billion of unclaimed pension pots in the UK? The question is, could one of them be yours? One of the things that changed in March 2017, so not long after I arrived in South Africa, is that the UK changed the rules and introduced a 25% exit tax if you took your private pension out of the UK and moved it over to what was called a ROPS jurisdiction, which South Africa was one. Unfortunately, it isn't anymore. It can't do that. It's been delisted. The pension solutions to transfer over to aren't available in South Africa anymore, I'm afraid. But even so, would you want to lose 25% of your fund to move it back into rands? Coming back to the first sort of slide that we're talking about, would it make more sense though, maybe just to keep it in the UK and take it from there? Previously, a lot of South Africans looked at doing transfers outside of the UK system because, say, they've changed the rules. They might change the rules again. We can't ever odds that. But when they changed that rule, it was perceived by a lot in our industry as a way of reducing a large number of those overseas transfers, because obviously once they're gone, they're outside of the UK government's control. So one of the questions to ask yourself, I suppose, is do you want to have your pension fund, whatever it is and however much it is, at the risk of those sort of changes of government policy in the future? So that's something to talk about with your financial planner. Whilst thinking about that, the UK pension system is under significant strain. This is because of the aging population and low interest rates. This has meant there's a lot of vanilla pension funds that have underperformed, and many schemes have seen significant deficits being magnified by the COVID pandemic, and then on top of that, the recent sell-off in the markets as a result of the Ukrainian-Russian situation. So by leaving your pension unreviewed, what you might find is that you are leaving it at risk, and in some cases actually the company, the underwriting company, might go into administration, and we've seen examples of that over the year. A recent report from PricewaterhouseCoopers identified that 5% of big companies in the UK are at risk of failure, just like British Home Stores, Monarch, Carillion, and many other examples. Thousands of BHS workers lost out on pension benefits, and they were sent over to what's called the Pension Protection Fund. And there's concerns that potentially there might be some alternatives that you should at least be aware of, depending on what scheme that you have. So the question is, if you do have a UK pension, it might be helping to pay for that financial freedom or that 30+ year holiday that we call retirement that we discussed earlier. So ask yourself some questions. Today, as you sit here now listening, do you know who your pension is with? Often pension providers change hands and you just get a new letter coming through announcing that it's been sold to yet another pension provider. Do you know how much it is worth today? Have you got an up-to-date statement, or is it sat in an inbox somewhere, or an in-tray, or did the dog eat it when it got posted through the door? Do you know what it's actually invested in? If you were to analyze it, do you actually know what your money is sat in at the moment? What are the investments underlying it? Do you know how badly it's been impacted by the coronavirus pandemic and the Ukrainian situation? Do you know how much those individual funds or investments have reduced by as a result of that? The most important question, though, is how is it performing against its peers? Okay, so if this was a horse race, is it at the front of the horse race? Is it in the middle, or is it lagging at the back? So, is it potentially underperforming in the long term? So, linked with all of that, what will it be worth in the future, and how much can you therefore plan to utilize at some point in the future to retire in South Africa? So if you've answered no to any of these questions, then feel free to contact us and utilize our free pension reconnection service. What our team will do is simply contact the pension providers for you. We'll get all the information together. We'll go through all the jargon that we deal with all day, every day. And depending on what you have in place, we'll present you with some options for what you might want to consider doing next. It's a very simple form. It's all done via DocuSign these days. That's one of the plus points, if there is one, from the pandemic. Nearly everything these days is being done online, so it's a very simple process. Okay, why is it so important, though, to gather this information? Well, remember what I said earlier on about the tax breaks available under the DTA, the dual tax agreement? Well, with the correct kind of UK pension, what you could receive is income in South Africa tax-free. Okay, if you haven't got it set up correctly, if it's having tax deducted unnecessarily at source, you could be paying the UK government up to 45% away unnecessarily. You're not paying unto Caesar what is due to them. You're paying more than you need to. If you do want to remove your pension outside the UK, you could again pay 25 to 55% as some kind of exit charge, depending on what methodology you use. And I don't want to bore you with the details of all of that, but it's not something you should really consider without professional advice. And the question is, ultimately, what is your pension? It's taking you to this retirement destination. Are you going there in a tank? Is it going super slowly, but it's well armored and it's going to get you there, but it's going to take a lot longer than most? Are you in a car, a very homogenized white Ford Mondeo doing 55 miles an hour in the middle lane of the motorway, while other pension providers are overtaking you at 70 miles an hour? Is it a jet fighter? Is it going to get you there in a few hours, but potentially be very expensive or fall out of the sky? All of those thoughts are, what we can clarify, so you know a little bit more about what you have in place currently. Last little thing, and again, sorry for the analogies, but imagine it like a sailing journey. So just a few degrees off. And where could your course take you over the next 10 years? Likewise, with a little bit of an adjustment, now you could have a significant impact in a positive for the future. So, points to consider. Okay, so what if you're coming back to South Africa and you haven't got any form of a pension vehicle whatsoever? What can you do about it? Well, good news is there are options, but first thing we need to do is consider, why should you? So do you want to have investments in currency other than rands? Was some of the things I said earlier on really resonating with you? Well, do you want those investments not to be affected by government decisions in South Africa? If we suddenly saw a very socialist government, even more than the current one here, what would that do for your investments if it was all in South Africa? Do you want to make sure that you have the ability to invest in all sorts of asset classes across the board, regardless of where they are? Everything from gold to property to stocks and shares, all in one very neat, tax-efficient solution. And would you want to make sure that your beneficiaries, your spouse and your children, got access to money seamlessly if you were to pass away at some point, maybe unexpectedly? I would say that's the second reason why I get to meet new clients. The first reason is I get introduced to lots of new clients on a regular basis from existing clients. But the second most common reason is someone's gone through a painful probate process. They've spent years dealing with executors and courts and all the rest of it, and never again is normally what I hear. So if you want to make sure that you don't fall into that trap, again, it's worth a conversation about how you can make sure you're well structured for that kind of worst case scenario. Okay, finally, I did mention this about our free budgeting tool. So again, if you're scratching your head on how to get started or what the typical costs may be, we've got this very simple and effective tool, and it's completely customizable. So just drop us an email and we'll be able to send you over it free of charge, and then hopefully it gives you something to start with based on the experience of all the others that have made this journey before. Okay, so on to our Q&A session. So if you haven't already, and I can see there's some questions in the Q&A section already, please just type away on a question now. It's in the center of the screen at the bottom, and I'll do my best to answer them. If you'd like to know anything more about what we've discussed today in more detail, don't hesitate to drop us an email or drop me a WhatsApp. Join my social media channels here, personal page there, as you can see on Facebook, and learn a little bit more about what it is that we do and how we help. Okay, so on to our questions. Let me just have a look at that. Okay, just answer this first question. Should you mortgage to buy to let in the UK? Apologies, anonymous. So I think what you're asking there is, does it make sense to get a mortgage and buy to let? It's what we call the Robert Kiyosaki principle. I'm a big fan of Robert's book, Rich Dad, Poor Dad. Residential property in the UK is so undersupplied. The demand is strong. You can leverage those gains using other people's money. You can fix interest rates at some of the lowest rates going. So yeah, I'm a big fan of investment property. Is it right for you? Can't answer that question, I'm afraid. We need to sit down and do that as part of a holistic financial plan. But yeah, it's something that I do encourage nearly all of my clients to consider if they haven't already done so. Okay, moving on to a question here from Lewis. What are the tax implications for working for a British company in South Africa? Who should I pay tax to? Yeah, this is a very simple question that I've done an entire webinar on before on just this question. It's very, very complicated, and I'll try and give you some headlines on what you should consider. And also, if you reach out to us, we can put you in touch with tax consultants, the likes of Janine Gelbroth, I work very closely with from Gelbroth Rushby, who's very experienced in dealing with a lot of expat clients that I look after. But in essence, when you come back to South Africa, at some point, you're going to become a South African tax resident again. Okay, one of the big common misconceptions is that it's something to do with visas. It has nothing to do with visas. It has everything to do with physical presence. Okay, how much time are you in whatever place? So if you're back in South Africa more than 6 months, you're going to be deemed to be physically present in South Africa, probably for that tax year. That being said, though, it can take up to 5 years before you become deemed a South African tax resident again. And there's a lot of little nuances that I simply can't cover today. Okay, so if you're working for an overseas UK company, then there's a number of other questions that go along with that. So, how many employees have they got in South Africa? If they've got more than one employee working remotely in South Africa, they might have to consider some of their obligations to employ you correctly. You might want to consider becoming a contractor or agency staff. I've got a lot of clients that are doing that, and maybe working for multiple businesses overseas. And there's ways that can be structured very, very effectively. I've also seen it structured terribly, because there's legislation in South Africa around place of effective management and the control of foreign corporations. Okay, so if you keep a UK limited business and you carry on working remotely from here, what SARS could do at some point in the future is say, well done for all those hundreds of thousands of pounds or dollars that you've been earning. Actually, we're owed 28% corporation tax rather than 19% in the UK. We're owed dividends tax at 20% rather than 7.5% in the UK, or words to that effect. It's, like I say, tax, unfortunately, is a very nuanced area. It's something that I would highly recommend getting professional advice on in your specific circumstances. But like I say, we've helped loads of digital nomads on getting structured effectively. The bottom line is you should consider doing it, but just make sure that you have a discussion about how best to achieve that. So hopefully, Lewis, that answers your question. Okay, moving on to Malcolm. Can you assist with double taxation for Canadian earnings whilst residing in South Africa? Same point, okay? Different tax rules, unfortunately, but again, the same principle applies. If you're working for an overseas business and you're earning primary currency, when you become a South African tax resident, SARS will have primacy on your worldwide assets and income, okay? Let me say that again. SARS eventually will have primacy on your worldwide assets, things that you own, and your worldwide income. Okay, you can't have a situation where you're paid in Canadian dollars and pay no tax there and not declare it to SARS at the appropriate point. Okay, but again, I'd recommend that's very much in the area of specialist tax advice. You need a tax consultant to do that for you. We aren't tax consultants, we are financial advisors. We know it very well because we deal with so many clients. But if you want to know the inner workings of the tax law, you want a tax opinion, we have tax consultants that we work with that can assist you with that. I hope, Malcolm, that answers your question. Okay. Jason and Wilma Gray. So hello, Jason. Hello, Wilma. We're in the Netherlands and my husband is American, working for an American company. Could we buy a house immediately when we arrive? Oh, that's a great question. Let me give you some examples of when I've seen clients doing this. You can get an overseas mortgage as an overseas investor for 50% of the property value. Again, first thing I would start with as the planner and say, well, look, how much do you want to bring in really for that property purchase? So if you're buying half of the property and you feel comfortable with that amount of euros being changed into rands, and maybe you bond the other 50%. Again, that's hypothetical. We need to discuss this on a one-to-one basis to make sure it is viable. But yeah, you can do that. It's very easy to do. It's low risk. You can do that now as an overseas investor. You don't have to be here to do that. There are some hoops that you need to go jump through. And if you're looking for somebody to assist that you with, I have some contacts for providers of bonds, not mortgages as they call them here in South Africa. So yes, you could buy it immediately when you arrive, or you could buy it before you leave. If you want to try and do a residential mortgage as a South African, it is challenging within the first few months of moving back because not all lenders will accept provable income to do sort of a 90-95% mortgage, but the 50% route, it's still pretty easy to secure. So just something to think about there. Hopefully that answers your question. Yeah, and another question is remote working is a good way to sort out taxes. Long story short, digital nomads. Yeah, I'm not trying to put you off doing it. Yes, there is a great way of doing it. There's lots of different ways that it can be done. Some are more effective than others. Some of them rely on a willing employer. Okay, some rely on potentially becoming a contractor. Some potentially rely on things like agency options and various other things. But there's lots of tools available. It's not something we can go into on this call. Unfortunately, it needs to be done on a bespoke approach. It needs to be done in conjunction with a tax consultant. But like I say, we can happily take you through some of the basics to give you a bit of a pointer on how we've seen others do it and who to speak to achieve that. Okay, moving on, another question from Anonymous. What about state pensions from the UK? Can one get this paid into the South African bank account? Yes, you can. Okay, the question is, why would you want to? Okay, so if you're getting it paid direct from HMRC into a South African bank account, what you're going to find is that the bank will charge the exchange rate of the day. You will lose a significant percentage doing it that way. Okay, 3-5% of a frictional cost. Absolutely, you're going to lose that, I'm afraid. What I advise my clients to think about is, I'd say something like Revolut. Okay, get it paid in pounds into a UK-based account, and then you decide when you want to move that money down to South Africa at a much higher exchange rate on the same day. I guarantee something like a TransferWise, Revolut, Monzo will have a higher rate of exchange than whatever high street bank you may be using. There won't be any commissions, there won't be any unnecessary fees if you do it that way. And these days, you can just go to Woolworths and spend on that debit card. You can use it on SnapScan. So it's a great way of doing it. So yes, you can get paid into a South African bank account. My advice is don't do it, but have a think about that. Okay. So a question here from Madeline, and thank you very much. I've still got another 7 questions to go. I'll do my best to get through them all. I've got a very small government pension. How can I get this out to use it in South Africa? I also have a Revelo account, but I get this paid in there. Well, I think I've just answered that one. So hopefully, Madeline, that helps you there. Best of luck with that. Okay, Jonathan here, thank you very much. I'm setting up a limited residential rental company with a business partner who's UK based. What would be the tax implications for me on things like dividends and rental income, particularly if you're going to be a digital nomad for a UK company? What would you recommend a limited company for rental properties in the outset? It's a really tricky one for me to answer, Jonathan. I'll do my best without getting myself into hot water. The dividends tax rate you should be paying on your foreign dividends as a South African tax resident is 20%. Okay. In the UK, the withholding tax is either 7.5% and rises to 32.5%. So you could have a situation where you've paid more tax or less tax unnecessarily in the UK. So again, that's a very specialist subject. Look, depending on the quantum, I mean, if you're talking about 10, 15, 20 properties, there's some great options around how you can structure this effectively. And actually, it can almost become tax-free completely if you structure it effectively. I can't again go into that now. It really needs more of a one-to-one discussion to talk through what it is that you're thinking. But yeah, I like your thinking. It makes sense, but just with a little bit more of a discussion, I think, to give you a few more options. Okay, Kevin, currently a sole trader in the UK. We've got clients in Switzerland and the UK. How would that work with tax? What are you setting up a UK company? Okay, UK company, again, I come back to one of the traps that I've seen happen. You know, people set up a UK limited company, they do it online, it's £12 to set it up, it's great, the whole time you're in the UK. When you come back to South Africa, at some point in the future, SARS is going to throw the book at you around a thing called POEM, Place of Effective Management, okay, and CFC, Control of Foreign Corporations, okay. They're going to want to see that they have not been disadvantaged by the tax they should have received by you pulling the strings on that business remotely from here in South Africa. That's it in a nutshell. You know, there's a lot of other little nuances. Again, I can't really go into it this time. It's more of a tax question. Yeah, look, there are some great options. I've got a number of clients that do consulting work all over the world, and we can build that through international billing vehicles that do work very effectively for South African tax residents. Again, I can't go into too much on a call like this, but yeah, very worthwhile having a chat. I think, Kevin, we might be able to give you some pointers on that. Okay, moving on. I'm sorry, I'm going to have to wrap this up in a minute. I'm trying to keep it succinct. We've got another few questions here. I'll try and get to all of them if I can. Thank you so much to everyone for attending. If there's anything you want to ask based on what we've discussed today, just drop me an email and my team and I will come back to you as soon as we can and maybe have a quick chat over Zoom, something like that. We're happy to do. So Kareen's asked, if I close my UK company and reopen in South Africa, can I still pay into my national insurance in the UK so that I can get my government pension in time? Again, it's an option, okay? Setting up in South Africa as a limited entity, I'm not saying do that necessarily. I'm saying that there are other options, other jurisdictions that are tax efficient. Again, it's probably best discussed face-to-face rather than in a forum like this. But the principle of can you top up your national insurance so that you get the state pension in the future? Yes, you can. Effectively, it's about £700 a year. You can buy another year's worth of contributions. With the new state pension system in the UK, if you want a full state pension, you have to have had at least 35 qualifying years. Okay, if you've got between 10 and 35, you'll get something, but it'll be a lower amount. One of the downsides of being a South African tax resident in the future, unfortunately, that pension will be frozen with inflation. It won't rise with the triple lock, as they call it in the UK. Unfortunately, that's only for UK residents. So yes, it can be done, but again, should you be doing it? Maybe there's some other alternatives you might want to consider on the investment side that maybe provide you a better alternative in the future. But again, something that we're quite happy to talk you through on a Zoom call or something like that. Okay, I think, so a question here from Robin. We've got fantastic relationships with very, very good tax consultants. Janine Gelbruff is the one that I use for virtually everything. Janine looks after me. She looks after my family. She looks after the vast majority of my clients. Any of her had good feedback. She's a very hardworking lady, great experience on the UK side. So happy to introduce you to her. We can do that after a chat if you think that might help, or we can do that in just direct introduction. Quite happy to do so. So Robin, hopefully that will help. And Robin, yes, question on life insurance. Again, another little trap here. Insurance companies love them or hate them. They will do their best to try and not pay out a claim if they can find an exclusion. Okay, one of the things that quite often applies to a life insurance policy, particularly with things like critical illness, is that you have to be a UK resident. Okay, so what we see is expats move away from the UK, they carry on paying, something happens, and then guess what? They don't get paid out on that policy. It depends on the wording of the policy. Okay, so check it. We're quite happy to check it alongside, when you make the move back, or alternatively look at, an international or South African alternative. There's some great solutions out there. So, just a little bit of a pointer there. Great question here on, do we need to have a will in place in South Africa and the UK separately? Okay, wills are fraught with danger. I've done a webinar before with some of our wills providers. Why is it fraught with danger? Nearly every will that you do in standalone writing will have a paragraph in it that says, I hereby renounce all previous wills. Okay, you do one in the UK with a provider and they'll have it in there. You then the next week do it with one in South Africa, they put it in there because what they don't want is dual wills to exist, right? It could complicate an estate situation. However, what you could then do by doing that is leave yourself effectively without a UK or international will. So in that situation, if you've left assets overseas, particularly somewhere like America, America's got one of the worst, highest rates of inheritance tax. It starts from $60,000 upwards. It's really punitive. In the UK, at least, it's £325,000 per head as a couple before you potentially start to pay inheritance tax. USA is really, really, really punitive. But regardless of that, when it comes to the will side of things, I'd really encourage you to think about getting specialist advice. Again, we can put you in touch with the right kind of wills writers that can do something that works for both jurisdictions, just so that you're not caught in that trap in the future. Okay, and one last question here from Jonathan. To add to the property question, if you're a dual citizen, do you still have to be an overseas investor? It's Jonathan, I think we could do with having a chat. I'll explain to you, maybe on a one-to-one basis, the options around various different lenders and that. But the bottom line is that if you are in South Africa and resident down here, I'm in the same boat. I've got a British passport. It's you get slightly better terms, but you're never going to get a high street rate. Certainly not a high street residential rate. That's the other thing. A lot of people, are used to a very low residential rate, and wow, they get blown away when it goes onto a standard variable rate, and then an expat overseas buy-to-let mortgage is more expensive than they're used to. So again, it's really worth understanding all of that before you make any of these kind of important decisions. So by all means, reach out to us and have a chat. We're just scanning through last few bits and pieces. I think we've covered most of what we needed to today, ladies and gentlemen. Sorry, there's still more questions coming in. I can't get around to all of them. I want to try and keep it no more than 50 minutes, and I have overrun. But thank you very much for joining today. I hope it's been of use. I just want to wrap up with saying the weather here is lovely. I've got some more family members that are looking at coming back down. They spent some time with us after COVID. I think they really get it now after spending a little bit of time in the Kruger. So you aren't alone, okay? Not everybody is leaving South Africa. Lots of people are coming back. All that we advocate is do that as part of a structured financial plan. Get yourself financially fit to return correctly. And we look forward to welcoming you back in this beautiful country. Ladies and gentlemen, thank you for attending today. Have a great remainder of the day. All the best.